When I look back to the start of my career in stockbroking back in early 1970, I saw a decade in the UK which led to gilts, which were government stock, if you like, being issued with coupons of over 15%. Now, we have a situation today where the production of money in the form of currency, in the form of bank credit, and all the rest of it has been so much greater than it was in those days, that we should not be surprised to find that inflation, by which the establishment means rising consumer prices, is actually not transient, but actually is considerably more stubborn to get rid of. And not only that, but if you think that an inflation rate of, I don't know, 8.5%, something like that in the US is the end of it, I've got a big disappointment for you, because it's going to go a whole load higher. And it's very easy to see why that is the case. And I think what we're seeing in the markets is, at the moment, is if you like, a growing realization that that is the problem. So where does this leave central banks and their governments and all the rest of it? Well, they're going to have to raise interest rates not to 3%, not to 5%, but possibly quite a bit higher. And where it'll stop, I really don't know. But there are a few things in the pipeline which always seem to happen when inflation becomes a real problem, such as we're going to have a crisis this year of food prices. We're already getting a crisis of energy, because what we've done is we've cut off the largest energy exporter in the world from Western markets, or tried to. This is going to be catastrophic, and particularly for two currencies. You're already seeing the two currencies which are hit most are the ones which have, first of all, negative deposit rates. That's the first thing. Secondly, a commercial banking system where the GSIBs, the global systemically important banks, have asset to equity ratios in excess of 20 times. The strains that you're seeing materialize in the fall in the purchasing power of the yen on the exchanges and all the rest of it, and also the euro, is really, it's becoming obvious. And how do they stop it? Well, the only way they can stop it is raise interest rates. But if a central bank like the ECB or the Bank of Japan raises interest rates, because they have got, they've become huge, great investment portfolios, predominantly in bonds, though recently you find that the Bank of Japan has also been buying equity ETFs. You will find that suddenly they're all in negative equity. Central banks in negative equity, this is crazy. So now I can understand how the Bank of Japan can recapitalize itself. We've seen this before throughout history. Basically what happens is that the Bank of Japan says to the government, we will lend you some money. But what we will do is, to counter the loan on one side of the balance sheet, we have to have, through double entry bookkeeping, an item on our liabilities side. But instead of it being a deposit in favor of you, which you then draw down, we will put it in the category of another liability, and that is equity. And that way we recapitalize ourselves. It's magic, isn't it? This is what banking is all about, because they're dealers in credit. This is basically what they do. Now, so that's fine. The only thing I would say is, for the Bank of Japan to have to recapitalize itself in the middle of a crisis is obviously not the best time to do it. It generally happens that when a central bank has to recapitalize itself, it is during a crisis. But then let's move over and see what happens to the ECB. The ECB can't do what I've just said the Bank of Japan can do, because its shareholders are all the national central banks. And guess what? The national central banks are in exactly the same position as the ECB. They don't have a government to turn to. And furthermore, they've got a banking system which, again, has assets to equity ratios in excess of 20 times, with certain major banks with quite large exposure to the Russian economy and the Ukrainian economy. This is going to be a very interesting one to see how they sort that lot out. This has never happened before, and it is not beyond anyone's imagination when they understand the facts and other things like the target 2 imbalances. I mean, like the Bundesbank is owed something like 1.1 trillion euros, which has got no chance of ever recovering because the counterparties on that are the ECB itself, also the Banca d'Italia, and also the Spanish central bank and the Greek central bank. I mean, this is an interesting situation. And then there is a further problem, which I don't think many people are aware about, and that is that, well, you've heard of the repo market. Basically, the repo market is the way in which banks rearrange their liquidity between themselves. But it's bigger than an interbank market. Interbank market basically is borrowing lower amounts of money without having to put up collateral. But the repo market involves collateral. Now, we're terribly excited when you see that the reverse repos, whereby the Fed at the moment is absorbing excess liquidity, is running at about I think it's about $1.7 trillion. Guess what the figure is for the total repos and reverse repos, without double counting? We're looking at about 8.3 trillion euros. I mean, so we have got the situation that I've described. Central bank with shareholders who are all bust as well. And you've got the GSIBs, the major banks on more than 20 times asset to equity ratio. You've got the target 2 system with all its imbalances. And on top of that, you've got banks which actually have used, I'm sorry to say, they've used the repo market as a means of concealing bad debts, because that's another thing. You get a local regulator, let's say the Italian regulator. He's approached by the banks whose auditors have said, these should really be classified as non-performing loans. So what does the local banking regulator does? He says, well, I tell you what, the thing to do is to put it into a bunch of collateral and lend it out to someone else via a repo, like into the target 2 system. And then it's off my patch as a regulator and I don't have to worry about it. And it therefore is no longer marked as a non-performing loan. Boom. So you got all this rubbish collateral within the system. And that brings me on to another major point. And that is that the whole of the Western world has moved from a banking system which is primarily focused at extending credit to producers, people who actually will take that credit and try and get a return on it. And the collateral that the banks have taken in the past were basically assets that produced a return. Now, I mean, it could be a charge, let us say, on a property or a factory or something like that. Or it could be shares in something which actually pays dividends and gives a return to the owner of the asset. From which the bank can then say, well, at least we have got a stream of income and value in the collateral, which underwrites the loan. We moved away from that, really from the Big Bang in the 1980s. And what's happened is that progressively, the collateral within the banking system has become purely financial. And I was actually thinking about how to describe this. When you look at this financial collateral, it's financial collateral of financial collateral. In other words, we're no longer talking about collateral that has any basis in terms of production, but it's things like derivatives, it's things like, government bonds and things like that. I mean, this is all non-productive stuff. These assets just don't produce anything. And so, you've now got a mountain of assets, rather like a sort of Ponzi scheme. And instead of it, I mean, do you remember in the Lehman crisis, we had credit default obligations, and then we had credit default obligations squared. Well, here we've got financial assets squared. And I think even more than that, financial assets to the power of n, where n is actually quite a significant number. And it's that, the whole of that procedure, which is beginning to topple. So this is not just the yen, it's not just the euro, it's the whole of the international banking system, which has become progressively divorced from assets which actually produce things in terms of the collateral that secures its lending. It's all just hot air. It's ethereal. And so when you get the systemic risk that inevitably is going to spread from the Japanese banking system and the euro system commercial banks, who knows where it's going to stop? I mean, this is something which I think is very, very serious. And it's what interested me was there's a guy called Zoltan Pozsar of Credit Suisse, who I'm sure a lot of your listeners have heard of. And I'm actually going to be debating this with him at the end of this week. But it's what interested me was the way he came up with this description of Bretton Woods 1, Bretton Woods 2, Bretton Woods 3. Now, this was, if you like, shorthand for, we all know what Bretton Woods 1 was, and that ended in August 1971. His version of Bretton Woods 2 was what followed it, which is this financial, the gradually increasing level of financialization within the banking system that we have running up to a problem today. And what he's now calling Bretton Woods 3 is the move from this financialization to a more commodity-based future. And we are seeing this with Russia and China, and not only that, but the central European states, which also includes Belarus, for example. And you've got Russia in this, and you've also got China being a partner in this, coming up with a new trade settlement currency. Now, we don't have details of this yet, but it appears that the plan is that this will be based on the currencies of the people involved, of the nations involved, and I don't know how, what proportion it will be, but something like 20 commodities, including energy, metals, and so on and so forth, which the area will be dependent on to back this new currency. So this, if you like, is a more commodity-based currency. So what we are seeing is we're seeing the whole of Asia, which is really the Shanghai Cooperation Organization, in which this sort of Central Asian bit is if you like, a core of the whole thing. This is 40% of the world's population are moving away from the West's financialized system into a more commodity-based system. Now, there's very, very good reason for doing this. And the reason, quite simply, is that if you're going to get the rising interest rates, which I have spoken about, 5 minutes ago, then, from Russia and China's point of view, and any of the various ex-Soviet states in Central Asia, they don't want to be seeing their interest rates rising as their currencies, which really have less credibility than the dollar, begins to collapse. So they are coming up with a new system to secure the currencies. And that means that the interest rates in those currencies are going to be a lot more sensible in terms of being able to run businesses, to raise capital and all the rest of it, than what we will endure in the West. What we will endure in the West is basically our interest rates, which defend people from the falling purchasing power in our currencies as this financial system unravels. And that could be an extremely high level of interest rates. Meanwhile, Asia hopes to escape this by divorcing itself from this problem. And that was the key part that Zoltan had really identified. And I was coming at it from, if you like, a geopolitical stance, but he was coming at it from a banking stance. So the thing that's fascinating is that with our different approaches, we have ended up, I think, at a similar conclusion.
All right. Well, Alasdair, this is a sign of one of the best interviews ever, where the interviewer doesn't have to ask any questions because you are connecting all the dots yourself. I hardly honestly know where to start, given all the notes that I've taken here. But if I can tease out some of the top highlights here, you see a system where the world's central banks largely are becoming, increasingly, certainly vulnerable. I almost want to say insolvent. In the way you described sort of at least the EU banking system, it sounds a lot like the same kind of vulnerability that the US banking system had back in 2008, where it's a systemic risk that you're worried about here. It sounds like there's so much bad debt out there at these over leveraged and hyper financialized, especially in terms of their collateral, right? That really hit home for me, where you talked about kind of the old banking that previous generations had. You lent out loans to a producer to do something productive, and the collateral that secured that was a productive asset. It was a factory, it was farmland, whatever. We now basically have a system that's built atop a concept, built atop another concept, built atop another concept. And if it comes time to claim that collateral, if we're in a crisis, you really just might have a claim on nothing, really, at the end of the day.
Exactly.
Or only financialized losses, and who knows? You're saying that sort of in that, given that context, Russia and Asia, led by China, are now actively looking to chart a different course. I would say, correct me if I'm wrong, I would say it's probably been accelerated by the conflict in the Ukraine. My guess is this was put in motion long before the Ukraine war happened.
Yeah, absolutely. I mean, this has been the direction of travel for the Shanghai Cooperation Organization, which basically defines the partnership between Russia and China and their control over the whole of the Asian and East European continent. So, that I think is the important point to understand. But China does not want to disrupt the rest of the world, as it were, the dollar world, unduly, because it relies on exports to America and also to Europe and elsewhere for its own economic stability. But the whole thing has been accelerated by the invasion of the Ukraine and the European, or if you like, the NATO response to that. So why did Putin invade the Ukraine? I've been convinced, and this is my sort of theory really, that what he wanted to do was to drive a wedge between America and Europe. He wants America out of Europe. He doesn't want to see America influencing Europe. I think he's perfectly prepared to live peacefully with the rest of Europe, because Europe is a good source, if you like, of demand for his energy exports, for all his other exports. It's a good source of trade. Not only that, but along with China, they have built-in communications, like a sort of fast, big railway, which runs all the way from Beijing through Russia, all the way to Stuttgart in Germany. And I mean, Mercedes can deliver a car into Beijing in 10 days. Equally, Zanussi in Italy, which makes white goods, has its factories in China. It can get product on the train and get it into Europe in 10 days. Doing it by sea takes 40 days. So you can see that the communications across the continent are extremely important. And I think that both Russia and China want to continue to use and build on that. But the one thing Russia wants is to get America out of Europe. And after the failures in Syria, for example, after the withdrawal from Afghanistan, you can see that from Russia's point of view, she sees America is on the run. And therefore, what she's done is she's effectively driven a wedge between Europe, and particularly Germany, which is so reliant on Russian energy, and America. And America, of course, I mean, America doesn't really have a problem. I mean, it doesn't buy anything out of Russia, really, nothing meaningful. So, they're fine, thank you very much. But the Europeans are really hit extremely hard by this. I mean, we saw only this week Spain's producer price index up 46% year on year. Germany's is up over 30% year on year. And the ECB has interest rates at minus 0.5%.
All three of those are crazy numbers.
The whole thing is actually set to fall over. And you can see exactly where Putin is coming from in this. What he's saying to Germany and Italy in particular, and the other nations, he's saying, look, I will sell you energy, and I will sell you energy at an attractive price, so long as you pay in rubles. And what has happened is that it's pushed the ruble up. I mean, the ruble at one stage was 150 to the dollar, and now it is about 74. That's as we speak.
Right, pretty much back to where it was before.
Absolutely, yeah. Before. In fact, it's slightly stronger than it was before all this happened. So the situation, as far as Russia is concerned, is, I mean, Putin's sitting there feeling relatively comfortable with the situation. Okay, it could have gone better in the Ukraine, but in terms of the economic position that Russia finds itself in, I mean, the last trade balance it declared was a record. I mean, that was for about a month ago. So Russia has not been hurt by this. If anything, she has benefited from rising commodity prices on the back of the sanctions, which have effectively cut her out of what Russia calls the unfriendly nations, the markets of the unfriendly nations. So, and when I look at the mainstream media in this country, and I'm sure it's similar in America, I mean, they seem to think that this is putting economic pressure on Putin. It's not. It really isn't. I mean, okay, a few oligarchs have had their yachts impounded, but c'est la vie. This is, Russia is actually doing very well out of this. And that is the thing that I think that the strategists in the West would hate to admit.
Okay.
So, yeah.
All right. So a few dots to connect for viewers here. So we had an interview on this program about 2 months ago with David Knight-Legg, who was the source for a New York Times article and then later on a Wall Street Journal article, basically saying if you look at the invasion of Ukraine through the lens of in his words, a heist, but really a takeover of Ukraine's energy assets, it really kind of in many ways sort of strengthens your theory there, Alasdair, which is, the war was to drive a wedge between America and Europe, really with resources, particularly energy resources, as his ace in the hole. Right. Yeah. And, we'll see how this plays out. But from your perspective, it sounds like you think it's playing out pretty well to his advantage, at least so far. Yeah. Now, if I can summarize sort of what you were saying earlier, and please correct me if this is wrong, but if I hear you correctly, it's what you're saying is Russia wants to basically wean Europe as much as possible off of America. And it's going to use commodities to do that, notably energy. And it's going to be basically the broker between Asia and Europe. And basically say, look, Europe, we can get you pretty much anything physical you need, whether we have it ourselves in Russia or whether our Asian partners have it, right? And then if I heard you correctly too, China is basically going to be the bridge between Russia and America and say, hey, look, we're not picking a favorite here. We're trying to be everybody's buddy. We're going to work with Russia. America, we can work with you too. And they're going to try to play that middle ground for as long as they can going forward. But it seems like this new, or I shouldn't say new, but this tightening relationship between Russia and China is becoming the real key to how we're going to move forward here. And you kind of gave some brief mention to the fact that that they are, or at least Russia for sure, is beginning to back the ruble, and making it a commodity-backed currency going forward. In stark contrast to how you were describing, the Western powers are really in the process of strongly devaluing their currencies, the purchasing power of their currencies, and that's going to form the basis of this new sort of Bretton Woods 3, new monetary phase here. So am I getting it right that you're basically saying, look, it's all about this increasing partnership between China and Russia to create this new type of way of doing things, both monetarily and trade wise, where at the root of both is real tangible things. It's a real departure from the financialization that's been kind of driving world events for the past 50 years.
Yeah, it's in effect returning to, if you like, a sort of a new version of Bretton Woods 1. But instead of having one commodity, gold, as the backing for paper currencies, they're talking about, if you like, a portfolio of commodities. And the thing that's interesting, if you look at the price of commodities in gold, I'll give you an example. The price of oil in gold since 1950 has fallen by 30%. The volatility in the price of oil is entirely in paper currencies. So the situation is actually, if you extend that into other commodities as well, you will find that similarly, the volatility of the price of those commodities in gold grams is actually pretty minor. Certainly compared with the volatility of those commodities priced in paper currencies. So what you can then say with some justification is that a portfolio, if you like, of commodities is the equivalent of having some sort of backing with gold. So, but the problem I think that they find with this new currency, this new trade settlement currency in the middle of Asia, the problem that they have with gold is that it is open to manipulation by Western nations. So what they want to do is they want to insulate themselves from that sort of manipulative effect which the Americans or the unfriendlies might impose on them, by having a wider spread of commodities which actually relate to their trade. So I think the way you described it, Adam, is right. We're going back to effectively where we were before Bretton Woods 1 ended, and this is a very, very different situation from the financialization, if you like, of markets.
All right. So, Alasdair, I'm going to have you back on because I feel like we're just scratching the surface of the world you're laying out for us here. But we do have limited time. So I want to use the remaining minutes we have to, kind of get to the, okay, so what does all this mean? Part of the discussion. So I guess two questions for you. One is we have a gold as a topic. We talk about a fair amount on this channel. I think we have a lot of people who view it as an asset with a lot of future potential ahead of it, both as a defense against the devaluation of currencies that you talked about, also as just sort of an undervalued asset. And you mentioned manipulation. There's, I'm sure, a subset of people that think that gold is being artificially suppressed here, and they're sort of waiting for that moment where it escapes the clutches of the central planners that are trying to crush it down, or the institutional players as well. So I guess two questions for you. One, what implications do you think this has for gold? I would assume that a return to the real in terms of a monetary backing by major world powers would be very gold friendly. And then secondly, and we'll kind of wrap it up with this question, is for people that are peering through this new lens that you've just put in front of their eyes, as you look forward the next couple of years, how could people position for this type of world as an investor? I would think it might be, hey, go out and build yourself a basket of hard commodities or whatnot, but don't let me put words in your mouth.
I mean, the way I look at it is I don't buy gold in order to realize a profit. I'm not investing in gold. I expect at the end of the day that I'll probably spend my gold, or when things stabilize and we return to currencies that are properly backed by gold, which could be a long way in the future, only then will I dispose of my gold for currencies, which I can then spend. And I think this is a very, very important distinction for people to understand. And, people who get upset at, the poor performance of gold, in dollars or whatever it might be, I think are actually missing the point of owning gold. For a start, it's got to be physical, and you are hoarding money. It is the top money. You are hoarding it, and you're not spending it. There will come a point where you spend it. And I think that the situation will become very, very clear for the Japanese and the Europeans in the Eurozone in the coming months, because the sort of crisis which I see brewing is actually going to be very, very major. And it will make all of us, I think, my goodness, if we've got all our eggs in the fiat currency basket, then there is the risk we will lose everything. I mean, apart from anything else, think of the valuation effect of rising interest rates on bonds, equities. I mean, I think we could be at the point where people start abandoning equities because, when things are when you get let's say, stagflation, let's call it that sort of situation, then there is an argument that you are better off in equities than you are in bonds, because bonds will give you a yield. I mean, the 10-year US Treasury yields 2.8% or something. Your equities, they don't really yield anything anymore because nobody pays any dividends. But you do get a return on sort of cash flow and all this sort of stuff, whatever argument you want to use. And you compare that with what you would get in bonds. So you're getting out of, say, 2.8% for something which is better in equities. But when interest rates start rising even further, there comes a point where the equity market starts tipping over and then falling. And I'm afraid to say that if you stand back from this market and you look at it objectively, you would come to the conclusion that the market is in a bubble, the likes of which we have never seen before. I mean, this is more than the South Sea bubble, it's more than tulip mania, it's more than the Mississippi bubble. I mean, this is a global bubble, all based on financial assets, which, as I've described it, is not just financial assets, but financial assets squared and to even higher powers, if you like, of multiplication. This is a very dangerous situation. And when this bubble pops, it really will take out virtually everything that anyone owns within the fiat currency system. Now, if you believe me and you think that Macleod's actually got a point, then you really should be getting out of the fiat currency system as much as you possibly can. And the only way you can do that, you can't rush out and buy rubles or this new yet to be invented currency in the middle of Europe. The only thing you can do is buy gold and silver, physical, and store it and hang on to it and keep it safe. That is the only hedge, really, out of a collapsing fiat currency system. So, I mean, I think that's the important point that I would make about anyone looking at gold as an investment. It's not an investment. You will end up spending it. You'll end up spending it because you will need something to spend. And it is, if you like, I think more like an insurance policy. And but the benefit is that if the insurance policy is not needed, then you will keep the premiums.
I'm hemming and hawing here because there's one question I'm debating whether to ask you, and I may as well just go do it. Only because there are people who are investing in another asset class for sort of similar reasons that you're talking about. Mm-hmm. And a proper answer is worth more time than we have here. So this is a little bit unfair. But for the cryptocurrency people who are saying, yeah, hey, this is why we say own Bitcoin, what would your response be?
It's very simple. And that is that gold and silver are legally money. Bitcoin is not. So how on earth, do you see Bitcoin being integrated into a global financial system? It's not going to happen. It really isn't. It's worked so far, if you like, rather like a super equity. And this is why it has been correlating with the equity market. If I'm right and the equity market is going to collapse on higher interest rates, then I'm afraid Bitcoin will go with it.
Okay, and I think it's fair to leave it at that. If folks in the comments say they want to hear more, we'll dig into it with you the next time we have you on here. I guess last question for you too, Alasdair, is just asking you to sort of speculate here. But if we get the type of collapse, gold is not widely held. No. Right. The audience viewing this video, probably skews very high in terms of gold ownership relative to the general population. I would say maybe extremely high, because if you own an ounce or two of physical gold, you own more physical gold than 99.99% of the population. What type of how dramatic do you think the repricing could be of gold versus just other assets if we get the type of, maybe collapse is too great a word, but maybe it's not, of the current fiat system that you foresee here?
Well, no, I think collapse is not too too dramatic a description. But I think the thing to bear in mind is that it is not gold going up; it is the purchasing power of currencies, paper currencies, going down, and they're going to have to go down enough to persuade the establishment, which is entirely Keynesian, that they have got it completely wrong, and that actually the old and long-standing definition of true money, which is gold and silver, was right after all. And I suspect that it will be when the politicians realize that what they're being paid or what they own in paper currency is becoming worthless, that they will actually turn to something which is more substantial. I don't think they will necessarily get it right from the off, but what I do see is that in this mix, before you get the complete collapse of paper currencies,